there, welcome to the Property Wealth Podcast. We're so glad you're joining us today.
Yeah, it's great to be here, Sarah. You know, today we've got something really interesting lined up.
Absolutely. We're diving into a concept that can really make a difference for those looking to invest in real estate. The 1% rule.
Right. The 1% rule is a simple yet powerful guideline that helps investors quickly assess potential cash-flowing rental properties.
Exactly. It's all about finding those gems that can generate income. And we'll break down how you can spot them fast.
And we're also going to touch on some practical strategies for evaluating properties, navigating the market, and even some common pitfalls to avoid.
Plus, we'll share some personal stories from our own investing journeys. You know, the highs and the lows and what we learned along the way.
Yeah, real estate isn't just about numbers. It's about people, experiences, and building wealth over time.
So if you're over 40 and looking to dive into real estate investing, stick around.
We'll guide you through the process, making it relatable and actionable.
Let's jump right in and explore how the 1% rule can help you find those cash-flowing rentals.
Sounds good. Let's get started. You know, Sarah, it's really interesting when you think about how the 1% rule fits into the lives of people over 40. I mean, at this stage in life, many folks are starting to think about retirement. And that timeline is, well, a lot closer than they might have realized, right?
Exactly. And with inflation being such a hot topic these days, it's more important than ever to have a strategy that helps protect against that. People want to make sure their savings aren't losing value while they're waiting to retire.
Absolutely, and that's where cash-flowing rentals come into play. The 1% rule can be a quick way to evaluate potential investments, especially when time is of the essence. You don't want to spend years chasing the perfect property. You want something that works for you right away.
Right, and I think about a friend of mine, let's call her Linda. She's in her early 50s and was feeling the pressure of her retirement savings. She found this duplex, and by applying the 1% rule, she realized it could bring in a solid monthly cash flow. That gave her a lot of peace of mind.
That's a perfect example. Linda was able to look at her investment with a clear lens. She wasn't just thinking about the property's value going up in the future. She was focused on that immediate cash flow. And, you know, for someone over 40, that can really alleviate some of the financial stress, especially with the uncertainty in the market right now.
Definitely. And, you know, the emotional side of financial security can't be overstated. When you have consistent cash flow from a rental property, it's like having a safety net. It allows you to take your time with decisions about retirement or even pursuing passions that may have been on hold.
Exactly. And speaking of emotional aspects, I remember working with a couple, the Johnsons. They were in their late 40s and really wanted to leave a legacy for their kids. They were worried about how they'd pass on wealth. By investing in rental properties that met the 1% rule, they not only created a source of income for themselves, but also established something valuable for their children.
That's so inspiring. I think a lot of listeners can relate to wanting to build something for their family. And let's not forget about how market shifts can impact our plans too.
You're spot on. The market can be unpredictable, and having cash flow from rentals helps cushion those shifts. If property values dip, you still have that income coming in, which keeps you afloat.
It's like a buffer against market volatility. And for someone who's, say, approaching retirement age, that kind of stability is so crucial, right? It gives them time to think about their next steps without the pressure of needing to sell a property immediately.
Absolutely. I can think of many investors who've faced challenges during market downturns, yet their rental income kept their heads above water. It really highlights the power of cash flow. And let's face it, with interest rates fluctuating, property values can be a bit of a roller coaster, so having a reliable income stream is a game changer.
Yeah, and for so many people, it's about creating that passive income. You can't afford to be overly reliant on just, traditional savings or retirement accounts.
Right, and especially with the way things are today, those traditional avenues, they just don't give you the same returns they used to. It's really about finding ways to make your money work for you. A rental property that meets the 1% rule can be a wise move in that direction.
And let's talk about that wealth transfer aspect again. If you're building a portfolio of cash-flowing properties, you're not just securing your own future, you're also setting your family up for success.
Exactly. I've seen families who've turned their inherited properties into a thriving business. They've kept the properties in the family, and use the cash flow to invest in their kids, education, or even help them buy their first homes.
That's such a beautiful way to think about it. It's not just about the money. It's about building a legacy and giving your family opportunities that they might not have otherwise.
Yes, and the beauty of the 1% rule is that it simplifies the process. It helps investors quickly identify properties that will generate that necessary cash flow. And that's so important, especially for those who may feel overwhelmed by the complexities of real estate investing later in life.
That's a good point. It's like having a compass in a foggy sea of options.
Exactly! And it's also about empowering people to take action. Many in this age group might feel hesitant to dive into real estate, thinking it's too late or too complicated. But using the 1% rule can demystify the process and encourage them to get started.
It's about breaking it down into manageable steps, right?
For sure. And once they grasp that, they can start to envision their future, the financial freedom, the time for family, and the ability to explore passions without the weight of financial anxiety.
Such a powerful motivator. So moving forward, it's all about understanding strategies that can help them identify the right properties and make informed decisions.
Exactly. And that's where we'll dive into some core strategies next, so listeners can feel equipped to find those cash-flowing rentals that can truly make a difference in their lives. So let's dive into the 1% rule, which is, a really handy tool for investors. The basic idea is that for a property to be considered a good cash-flowing rental, the monthly rent should be at least 1% of the purchase price.
Right. So if you buy a house for, say, $200,000, you'd want to aim for at least $2,000 in rent each month.
Exactly. It's a quick way to gauge whether a property could work for your portfolio, but it's not the only metric you should consider.
Yeah, I imagine there's more to it than just that. What else should investors keep in mind?
Well, there's the 50% rule, which suggests that you should estimate your operating expenses to be about 50% of your rental income. So if that $2,000 rent is coming in, you might expect your expenses to be around $1,000.
So that gives you a rough idea of your cash flow after expenses, right?
Exactly. So if you take that $2,000 rent and subtract the $1,000 for expenses, you'd be left with $1,000.
Nice. And that's before you factor in your mortgage, I assume.
Right. So let's say your mortgage payment is $800 a month. After that, you'd be left with $200 of cash flow.
Which is still something, but not a huge amount, right?
Yeah, that's why it's crucial to consider all these numbers together. And, also look at the cap rate, which is another useful metric.
Cap rate? How does that work?
So the cap rate is your property's net operating income divided by its purchase price. It gives you a percentage that helps compare properties.
Okay. So if your net operating income is $12,000 a year on that $200,000 property, your cap rate would be
6%. You divide $12,000 by $200,000 and then multiply by 100 for the percentage. That's a solid cap rate.
And what does that tell you about the investment?
A higher cap rate usually indicates a better return on investment, but it can also mean higher risk. So it's all about balance.
I see. And I suppose that's why it's important to look at multiple properties before making a decision, right?
Absolutely. You want to create a checklist for evaluating deals. Include things like location, property condition, and potential for appreciation.
Right. And also consider the neighborhood's rental demand.
Exactly. A property in a desirable area with strong rental demand can often command higher rents over time, which can make a big difference in your cash flow.
So what about financing options? I know that can be a big part of the equation too.
Yes, financing is key. Traditional mortgages are common, but there are other options, like private loans, hard money loans, or even seller financing.
Seller financing? That sounds interesting. How does that work?
Well, in seller financing, the seller acts as the bank and allows you to make monthly payments directly to them.
So if you don't have great credit or can't secure a bank loan, that could be a viable alternative?
Exactly. Just remember that the terms can vary greatly, so you'll want to negotiate something that works for both parties.
Got it. And how about property types? Are some better suited for cash flowing than others?
Generally, single-family homes can be easier to manage and rent out, but multifamily properties can offer better cash flow potential.
Right, because you have multiple units bringing in rent.
Exactly. And don't forget about things like short-term rentals. They can provide higher income, but they come with their own challenges.
Like, dealing with turnover and cleaning between guests?
Yes, and local regulations can be tricky too. It's essential to know your market's rules before diving in.
So it sounds like doing your homework is crucial.
Definitely. You want to gather all the information before making any decisions. And then, once you've narrowed down your options, start running the numbers on each property.
Right. I assume that's where a deal evaluation checklist comes in handy again?
Yes. You can create a simple checklist that includes all the key metrics we've talked about. 1% rule, 50% rule, cap rate, and any other factors relevant to your goals.
I love that. It's like having a personal guide to keep you on track while evaluating properties.
Exactly. And it can help you avoid emotional decisions. Sometimes, when you fall in love with a property, it's easy to overlook the numbers.
Oh, so true. I've heard stories of investors getting attached to a property, but then regretting it later.
That's why sticking to your checklist is so important. It keeps you focused on your investment criteria instead of getting swept up in the excitement.
And, of course, there are always common pitfalls to watch out for.
Yes, and that's a big part of our next conversation.
I can't wait to hear about those. They can really make or break an investment strategy.
Absolutely. There are definitely risks involved, but with the right approach, you can navigate them effectively. Sarah, when we talk about the 1% rule, it's easy to get excited and jump right in, but there are definitely some common pitfalls that can trip up even the most seasoned investors.
Absolutely, Mike. I think one of the biggest mistakes is over-leveraging. People often think, I can take on more debt and it'll all work out, right?
Exactly. They see that potential for cash flow and think they can leverage their way to success. But if market conditions shift, or if expenses rise, they can find themselves in a tight spot. I've seen investors stretch their finances too thin, and when one thing goes wrong, it can snowball.
Can you share a real example of that?
Sure. I once worked with a couple who bought multiple properties all at once, thinking they'd cash flow like crazy. They were so focused on the potential income that they didn't account for things like maintenance costs or vacancies. When a couple of tenants moved out unexpectedly, their cash flow took a hit, and they were left scrambling to cover their mortgage payments.
Wow, that sounds stressful. So what could they have done differently?
Well, a more measured approach would have been to start with one property, maybe two, and really understand the cash flow before diving deeper. Setting aside a reserve fund for unexpected expenses is critical.
That makes so much sense. And what about bad tenants? That seems like a huge risk.
Absolutely. Bad tenants can wreak havoc on your cash flow. I remember a client who was so eager to fill a vacancy that they didn't do proper screening and ended up with tenants who paid late, damaged the property, and caused all sorts of headaches.
That's tough. So what should investors look for when screening tenants?
Look for red flags in their application, like inconsistent employment history, poor credit scores, or previous evictions. And I always say, trust your gut. If something feels off, it probably is.
Yeah, I totally get that. And then there's ignoring cash flow. That's a big one too, right?
Definitely. Some investors get so caught up in the potential appreciation of a property that they forget about the cash flow. They might buy in a hot market, thinking prices will keep rising, but if the cash flow isn't there, they could be in trouble.
I've heard stories of people holding onto properties for years, just waiting for that appreciation, but the cash flow just isn't there. It's kind of a gamble.
Exactly. I had a friend who bought in a trendy area thinking it was a sure thing, but the rents didn't cover the mortgage, and he ended up losing money every month. It's crucial to analyze the numbers, not just the potential for growth.
And then there's the whole concept of timing the market. A lot of people think they can time their investments perfectly.
Right, and that's a slippery slope. Market timing is really tricky, and nobody can predict the future. I've seen investors wait for the perfect moment to jump in, and in the meantime, they miss out on great opportunities. Or worse, the market shifts, and they find themselves stuck.
So it's more about being consistent and strategic rather than trying to catch the wave at the right time?
Exactly. Focus on your strategy and stick to it. If you're following the 1% rule, you're already on the right track.
And what about hidden costs? Those can really add up, can't they?
Oh, for sure. Many new investors overlook things like property management fees, maintenance costs, and even HOA fees. I had a client who bought a property thinking they'd make a killing, but once they factored in all the hidden costs, their profit margin shrank significantly.
That's a tough lesson to learn. How can investors prepare for those hidden costs?
It's all about doing your homework. Create a detailed budget that includes all potential expenses. And don't forget to account for annual increases in property taxes or insurance. They can really sneak up on you.
So it's really about having a comprehensive view of your investments, isn't it?
Exactly. And being proactive rather than reactive. If you can spot these red flags early on, you can adjust your strategy before things go south.
I love that. It's empowering to know that, with the right approach, investors can avoid these pitfalls.
Absolutely. And if you do find yourself in a tough spot, it's not the end of the world. You can reassess your situation, tighten your budget, or even consider selling or refinancing to get back on track.
That's really encouraging, Mike. So, to wrap up this section, what would you say are the key takeaways for our listeners to keep in mind?
Well, first, always analyze cash flow before anything else. Don't over-leverage and make sure to thoroughly screen your tenants. And remember to factor in all potential expenses, including those hidden costs.
And timing the market, it's more about consistency and strategy than trying to hit the perfect moment, right?
Exactly. Stay focused on your long-term goals, and don't let the fear of missing out push you into hasty decisions.
Fantastic advice, Mike. I think our listeners will really appreciate these insights.
I hope so. It's all about building that solid foundation for long-term wealth.
And with that in mind, let's move on to the next steps for our listeners. What can they do to put this knowledge into action?
All right, so let's dive into some practical steps that our listeners can take right now to leverage the 1% rule in their real estate investing journey.
Absolutely. And the great thing is that you don't have to have a ton of experience to get started. Just a few actionable steps can make a big difference.
Exactly. So first off, I'd say start by analyzing one deal a week. It might sound simple, but just getting in the habit of looking at properties can really sharpen your skills.
Yeah, and it helps you get familiar with the market. You can use tools like Zillow or Realtor.com to find listings. Just filter for properties that are in your price range.
Right, and once you've found a few potential deals, you'll want to calculate the numbers. That's where tools like the Bigger Pockets calculator come in handy. It's user-friendly and allows you to input your projected rents and expenses. Super straightforward.
I love that tool. And for those who might be focusing strictly on rental income, Rentometer is another great option. It gives you a quick look at what similar properties are renting for in the area.
For sure. And if you have access to your local MLS, that's a goldmine of information. You can get detailed insights on recent sales, which can help you identify trends.
So what about books? Any recommendations that really helped you when you were starting out?
Oh, absolutely. One that comes to mind is the book on rental property investing by Brandon Turner. It's comprehensive and really breaks down the process.
Yeah, I've heard great things about that one. And what about podcasts? There are so many out there.
Well, I definitely recommend Bigger Pockets podcast. They feature real investors sharing their stories and strategies. It's inspiring and full of practical tips.
That sounds perfect. And, one of the best habits to start is to join a local real estate meetup. It's a fantastic way to network with others who are on the same journey.
Exactly. Engaging with a community can provide support and motivation. Plus, you get to learn from other people's experiences, which can be invaluable.
And remember, it's all about starting where you are. You don't need to know everything before you make your first move. Just take small, consistent steps.
Yes! And don't forget to track your progress. Maybe keep a journal or a spreadsheet to log the deals you analyze and what you learn from each one.
That's a great idea. It'll help you see how far you've come, which can be really motivating.
And if you stumble upon a deal that looks promising, don't hesitate to run the numbers through DealCheck. It's another handy app for analyzing investment properties.
Right. And it's important to stay updated on your local market conditions. Subscribe to newsletters or follow local real estate groups on social media for insights.
100%. The more informed you are, the better your decisions will be. And always remember, it's okay to ask questions. Reach out to more experienced investors for advice. Most are happy to help.
Yeah, it's such a supportive community. So to recap some of the immediate steps, analyze a deal each week, use tools like Zillow and BiggerPockets, dive into those recommended books and podcasts, and connect with local meetups.
Exactly. With these tools in your pocket, you're ready to move forward. Let's recap what we've covered today. So as we wrap up, let's quickly recap some key takeaways from the 1% rule.
Absolutely, Mike. One of the big ones is, well, the 1% rule itself, right? Finding properties where the monthly rent is at least 1% of the purchase price.
Right, that's a solid benchmark to help you identify cash flowing rentals quickly. And it's a great way to filter out properties that might not meet your financial goals.
Exactly. And then there's the importance of understanding your market. Knowing, like, what's typical for your area can really make or break your investment strategy.
Yes, and don't forget the necessity of doing your due diligence. You have to, run the numbers and assess potential expenses, repairs, and all those hidden costs.
For sure. And finally, patience is key. Building wealth through real estate isn't a sprint, it's more like a marathon, right?
Definitely. It's all about taking those calculated steps over time.
So for everyone listening, remember that with the right approach, you can build long-term wealth through real estate.
And don't hesitate to start small, if that's what works for you.
If you enjoyed today's discussion, please like, subscribe, and share your biggest takeaway or any questions you might have in the comments.
And if you know someone over 40 who's considering investing in property, share this episode with them. It could really make a difference.
Next time, we'll dive into the BRRRR strategy. Buy, rehab, rent, refinance, repeat. We're going to break it down simply so you can see how powerful this approach can be.
It's going to be great, so don't miss it.
Thanks for joining us today, and we can't wait to see you in the next episode.
Take care, everyone.
Bye for now.